What are some commercial real estate terms you need to know? Well, I'm gonna give you 7 of them today, and it's very important you know these terms. No matter what you're buying, an office, warehouse, apartment, you need to know these terms if you want to be a commercial real estate investor. If this is the first time we're meeting, my name is Tim Diesel and I'm a commercial real estate consultant. This channel is designed to give you tips and strategies in your business to help you excel or for your clients to help them get ahead. All right, so the first term you want to know is an LOI, letter of intent. Whether you're buying or leasing, you need to have a letter of intent, or you should. You don't need to have it. It's a good idea. Helps get your point across much quicker. So I did make a video and I made a podcast recording about an LOI. Make sure you brush up on that. I'm not going to get into that today. These are just 7 terms I want to give you, and I know to really help you along. But LOI is number 1, letter of intent. All right, number 2 is LTV, loan to value. You'll hear this in the residential world. This is very important you know this. I discussed a couple of times when you reach out to a lender and you want to do your research, the very first question you're going to ask them is, hey, what's the LTV on this type of asset? If it's an office building, maybe they might say 65%, an apartment, they might say 80%. You need to know what the LTV is, right? So loan to value, that's definitely something you want to know and you want to pay attention to when you're talking to your banks. All right, guys, number 3 is DCR, debt coverage ratio. This is the amount of debt the property will support. Now, I'll do another video and I'll really get into each one of these so you have a better understanding, but I just want you to know these terms. So your debt coverage ratio by the bank, usually the minimum is 1.20. I want you to stay at 1.25. That's how when you know you're kind of safe. The higher up you go, 1.4, 1.5, even better. So 1.2 is our kind of our floor. That's usually what the banks will say, this is it. Debt coverage ratio is very important to understand. All right, then it's NOI, net operating income. This is the holy grail when it comes to identifying value on a property. It's the net operating income. How much money comes home at the end of the day? Got to know your NOI. So your debt is important, you want to know, but you really want to know what the net income is, right? So net operating income, net OI, is the next term you should know. All right, guys, then it's cap rate. You'll see cap rate thrown around all the time. Cap rate is simply a return that the property has, not the return the investor is going to get. It's the return on the property. So it's very, very important. Your cap rate fluctuates. Every state, every city has something different. So I'm not expecting you to know what the cap rates are everywhere. Understand what the cap rate is. So if somebody says, hey, I'm looking for an 8 cap on my money, well, is that an 8% return on your initial investment or the property, or you really want to understand what the cap rate is in your market. I don't know what the percentages are, but cap rate is simply the return that the property produces for the investor. After that, it's COC, cash on cash. That means if you're putting $50,000 down into an investment and you're getting back $10,000 on that $50,000, it's just a return on your money. So it's how much money did you put into the deal and how much return are you getting on that money. So your cap rate could be 10% on the entire property, but maybe you didn't put $1 million into the deal. Maybe you only put 100,000. And if the deal spits off 100,000, well, the cash on cash return is 100% because you're getting back every dollar you've put in. Now on the entire deal, it's only 10%. So cash on cash is important to the investor because how much money are we putting in to make this deal happen? And that's very important to keep an eye on. And it goes back to your loan to value, how much debt will support. So keep an eye on your cash return, not so much the cap rate. Cash on cash is more important than cap rate. All right, the last one is GRM. This is the term that I hate the most, but it's gonna come across. You guys are gonna see it. A lot of brokers in California, New York, they all throw this term around, GRM. I don't even want to tell you what it means. Really go look it up, research it yourself. It's a waste of a formula. don't ever pay attention to that, because that is the gross, and it's very difficult when you're trying to piece property together, because remember what I told you, the net is what's important. The gross doesn't matter. The bank doesn't look at the gross. Nobody looks at the gross. But a lot of brokers, they'll use this in their pro forma numbers to mislead you and show you something that really isn't necessarily true. And as a true investor, your GRM is worthless. That's not a real number. But you do need to know it's out there, and you do need to know you're going to come across it. Do not pay attention to the GRM. I don't even want to tell you what it stands for. That's how much I'm against it. All right, guys, my question of the day is, was this helpful? That's all I want to know. Just comment, was this helpful? Did you learn a lot? Did you get anything new out of it? Or was this all stuff you already knew? Comment below. All right, guys, that's all I got for you today. Like this video, subscribe to this channel, comment below. If you have any questions, let me know. I answer them all. And I hope this was helpful. Thank you guys for watching.